Everyone, it is 9:40 p.m. on Friday, November the 9th. So hopefully everybody was making a little bit of money here. It's fairly easy to make money on the uh, movements today. Notice the VXX that I was talking about yesterday developed that near term 15-minute upside divergence, and it was constructive enough to send the price up from the middle of the day yesterday up until about the middle of the day today. It lasted for almost exactly one full trading day. And the price, of course, with the divergence in place at the lows, the price was hovering around 31.5 on the VXX, and it moved up to those peaks at around near $34, a little bit over $34 here late in the day today. But the technical picture stalled at around noon today, so a good time to exit there when the technical picture stalls. And so, had you done that, we're looking at call options on the VXX. So that would have been, of course, call options that were under 10 cents a share, expire today, 33.50s were the first ones. They were 9 cents yesterday or 8 cents or so yesterday afternoon, and around noon, 8 cents. And they went to a high of just around 80 cents today, so right at 900% return before it started to stall there late this afternoon. And of course, you could see that too, because where you would have sold would have been right here, not over here. We sell when the technical pattern that feeds the strength that was there stops feeding into it. So you look at the lower time frames, you can see the stalling taking place from this morning, and then you start to show a downside divergence. So these would have been prime times to have exited the trade. And this one here actually shows that 5-minute chart with a downside divergence at about 11:05 today. So had you held, let's go back and take a look, see again here. 33.5 calls. And today, at that point in time there, around 11:05, those options that were 8 cents yesterday were 60 cents today. So just about 8 times your money. And you see how it started to fluctuate around back and forth, and it came all the way down here to 30 cents or whatever it is, and then back up to retest near the same 60-cent level. What's the point in holding it through the up and down gyrations? The things I keep trying to impress on everyone. All we want to do is take the surge out of it. We don't care about holding on for the last penny. You don't know when it's going to be the last penny anyway. We're trading with technical patterns, so I mean the price may have gone, a couple of pennies higher over here than it was over here, but for technical trading reasons, this would have been your exit point, like I just showed you on the 5-minute chart when it showed an actual downside divergence that was not capable of continuing to strongly. I use that word a lot. I don't think anybody really understands what I'm talking about. You have to have strong upward momentum to keep carrying the price and for you to feel that level of confidence that I keep talking about every day. If you want to feel confident and not fearful about your trading decisions, then you have to have a technical pattern that feeds strongly into the direction that you're holding the options. When that stops and you don't stop, then that's a problem that you have to fix. It's not one that I can fix. So I'm explaining it now, as I've done so many times before. So if you don't want to sell when the technical momentum has clearly shown that it's not capable of strongly driving the price in your said direction, then you set yourself up for intentional failure. It's not me that sets you up, it's you that sets you up. So once you understand that, it'll be easy to make trading decisions for entry and exit both. Anyway, you take that information, the volatility index that had the upside divergence yesterday, and how does that translate to the SPY for downside patterns and things like that. We'll look at the same time frame that we had the divergence on. You see that there was technical weakness that began yesterday morning, and then as the price was topping out around noon yesterday, you can see the downside acceleration that was imminent in the SPY, as it was just as clear on the VXX for the upside move. So this is showing you clearly that it's going to move down. Do we have some things that are much more defined? Of course. Nice, clean, clear V-shaped patterns. This is really not one of those. See, so VXX had actually a cleaner pattern. It had that kind of V-shaped formation. It was the reverse of this, but we use, like I've explained so frequently, we use the information on the VXX to see how it translates to the SPY and to the other major index averages. So which of those have the cleanest and clearest picture is the one that would be the easiest to trade. So anyway, the SPY was sitting over 281 yesterday and came down as low as 276 today. So that's a $5 drop in the index since yesterday. And let's see how that translated to the options pricing. So 277, let's just pick one here. This is an example. Had you purchased the options yesterday sometime during the late part of the day, like the 277, see, these were not under a dime. It'd be a little difficult to justify, when it's that far out of the money and it's the day before expiration. This is what I keep explaining. You understand your instrument. The VXX options were fairly priced, but the SPY options were not fairly priced. See, this, like even the low yesterday was around, looked like 12 or 14 cents or whatever it was. That's too expensive for something that's $4 or $5 out of the money that expire the very next day. That's too much. That's too much money. So anyway, it looked like, let's just say, I don't know, like 14, 15 cents or something like that. And then the high today was $1.15. You're only talking about 7 or maybe 8 times your money there. It's a little difficult to justify, even after looking at it after the fact here. If I can't buy the options under 10 cents, and that would have been buying like these 276 puts. See, like even these were trading at 11 or 12 cents. So it's $5 out of the money. It's too much money again. See, so that means you have to dip down further yet. 275s, and see these late yesterday. They were trading, maybe around a dime. I can't even tell here at the low point. You see what I mean? It's not a good trading strategy. See this? The price kind of flatlined there, didn't really do anything. And even at the lowest point yesterday, maybe you could have purchased these options for maybe 8 cents or something like that. These 275s, $6 and something out of the money. And then today at the peak, like early in the day, they went to 28 cents from, say, 8-cent low. You're only talking about 3 or 3.5 times your money. That's not nearly what you should get. Whereas you saw the VXX options were 10 times your money. See? So we've seen this now, if you're paying attention. I've explained it for the last couple of weeks. Say the VXX options themselves are actually more fairly valued than the index options of the major indexes. Now, individual component stocks don't necessarily have the same volatility references to their prices. So some of the individual components, whether it's an Apple or your, Facebooks or whatever, that are heavily traded, they probably had pretty good valuations, as far as being able to buy their options today. That would have been a little more fair. Here's Apple. Of course, they all have the same technical weakness. Apple was sitting near its highs yesterday, and the technicals were lower than they had been, been progressively lower. no ideal looking patterns there that I could see and stuff like that. It's just, the same basic kind of weakness like we saw in the markets. And of course, these individual stocks are all components of the major averages and are affected by what the volatility shows, but the volatility premiums in the individual stock options are usually not the same as those of the indexes. So, you may have been able to get a better valuation on these. Apple was sitting at 208 yesterday, went down to 202 today. During the course of the day, didn't end there. So it looked at, say, I don't know, 205 put or something like that. See what they did. They were 18 cents yesterday. Went to $2.68 today. So see that outperformed the options percentage wise and things like that on the major indexes and things like that. 202 and a half on Apple would be the next strike price down. The first one under a dime, and they were trading for about 6 cents yesterday, and they went to a high today of about 80 cents. So also over 1,000%, and it did not get all the way down to slice too far under that strike price, but it did make it there. See, Amazon. This is an example. This is 15-minute chart to try to correspond with what we saw in the volatility. Of course, we'd be the reverse here because volatility goes the opposite way. And this should be the same direction as the divergence on the QQQ, Russell 2000, SPY. And this was yesterday morning, and Amazon was sitting around 1784. It came down to 1700 today. It lost $84 a share since yesterday. And let's see how that particular thing translates to put profits. What do you think? 1740? Would that be far enough out of the money, you think? It's a long way out of the money. From 1784 to 1740 is $45 or so out of the money. And yet these options that far out of the money were still $5. But today they went as high as around $40. So that's 8 times your money. There's a high spread between the bid and ask on Amazon and things like that. So I don't know. It's this and these options on Amazon would not have outperformed the major indexes like the Qs and things like that. So, it's really just things that have more fairly valued options. Let's see, Facebook itself was trading for let's see, 151 yesterday, went to 144 today. So maybe the Facebook. Here, the 145 puts as an example. This morning, even. Same thing with this. They were overpriced. 145 put, too much money. Too much money all day yesterday. That 14, 15 cents or whatever it was this morning is way too much. And it moved to $1. Okay, so you only made about 7 times your money. See, these were also overpriced. You can just judge by how far out of the money something is, and like I said, understand the instrument. How far away is the expiration? In this case, this was this morning, and the options expired today, so it's only hours away, and it was many dollars out of the money, and you still couldn't find them under 10 cents. So that's bad value. It's no good. It's not that it wouldn't make a good profit, 6 or 7 times your money. Of course, it's good, but it should be a lot better than that. And some things are. Netflix, the one that had that double upgrade from all the analysts the other day. Buy, 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 buy. Well, maybe they should triple upgrade it now because it's a lot lower now than it was yesterday. Yesterday it was $332 a share. Today it was $298. Seems to me like that's a $34 drop since the double upgrade. What it looks like to me. That's why I'm saying, and I explained in Twitter that it's only the technical patterns we're interested in. If you have that information and they're saying, great, upgrade, upgrade, up. If you're reading that kind of gibberish, we need a pattern. So where's the pattern that says buy? Late in the day today, you see that there were some technical references to an up move. See? Okay. So maybe then you could take their double or triple upgrades, and now that the technical pattern says that the price will move, then you could take advantage of it. But on the down move today, since yesterday at 332 and then down to 300 today, so you're talking about what, how far out of the money? Let's just pick one. 320 puts yesterday, they were $1.43. They went to $21 today. See that? How about a 310 put? 44 cents yesterday. It's still, you know, I don't know about with Netflix that it's so overvalued, because we know that Netflix, like it keeps doing, it moves in these 10, 15, 20, $30 increments. So maybe it's not so overvalued, knowing that it has the potential to move like that. Some stocks do that, and so part of the valuation in their options reflects that. But anyway, those options yesterday at 310 puts from 332 on the stock price. Remember, that's $22 out of the money, and the options expired the next day. But you see what the stock does. It just dropped a great chunk off the price. Anyway, these options went from 44 cents up to $12. So that's pushing close to 30 times your money, nearly 3,000%. Let's check a little lower strike price. How about the 300 even puts? Yesterday, they were trading for about 10 cents. Today, they went to nearly $3, also about 3,000% return. See? So these were more fairly priced. So individual components were more fairly priced than the indexes that appeared, but it was not across the board. So it's more of a, you have to understand certain stocks and just take a quick gander at those particular ones and understand the ones that we've gone over that have a propensity to move more dollar wise in a very short period of time. Tesla's another one that can do that, move very quickly if the technical pattern is present. Today, a technical pattern was not present for a nice down move or anything, or yesterday was not present. So Tesla did not make much of a move at all. But go back to this Netflix thing again, just for reference, near-term reference. At the end of the day, near the end of the day, like a couple hours left in the day today, the stock price was still hovering under 300. You see, so with less than 2 hours left in the day, this is what I was explaining the other day in Twitter. But you have to stay with it, because I don't know when it's going to show up. It's going to show up whenever the technical pattern shows up. So I'm not going to track every single stock and tell everybody everything at the exact moment it happens, because you might not be there to see it anyway. So what good would it do? But anyway, if you looked at the 300 or the 305 calls from 2 o'clock today, see what happened. They were trading for about, well, they're pretty cheap, and they moved up to, I don't know what the price is. You have to look more closely at it, the valuation there. From 2 o'clock area here, it looks like those options are trading for around 10 cents, and they moved up to over $1. So that's about 10 times your money on just that little rebound in the price. See, that's what I was explaining on Twitter the other day, to watch the lower time frames. It's not the news, but if you take the news and wait for the chart pattern to appear that will validate what those double, triple, quadruple upgrades are saying, then you can make money. Or how about if you just don't listen to the news? How about if you don't look at it at all and just watch the charts? See, the same thing is true, only you eliminate one of the steps, the news, and you still make the 10 times your money. See what I mean? So that's why it's better just to pay attention to the charts, know what you're looking for, and know the instrument you're trading. Know that near the end of the day, like this, if the technical pattern appears with clear references, then you can make a good profit very, very quickly. How that translate to the major indexes, Qs that Netflix and everything is part of. Did you have an upside divergence on that? Yep, you sure did. See, the index was sitting just over 170 on the Qs, just for a call trade. Of course, I know the market was down today. Doesn't have anything to do with what I'm doing, though. Like I keep telling everybody, it has absolutely zero to do with what I do. I don't care whether the market's up, down, or sideways. It means nothing to me. I'm looking for a pattern. See here, like for instance, this is the 171 calls late in the day today, 2:30 in the afternoon or so today. Hour and a half left in the day. I pulled up a strike price at random here. The 171 calls were 20 cents. They moved up to well over $1, so almost 6 times your money, just like that on that move. The 171 and a half calls, they were sitting at 10 cents and they moved up to 65 cents or thereabouts, so 6.5 times your money on the rebound. See that? That's fairly valued. The put options were not fairly valued. But when you look at something like this close to the end of the day, and this is not very far above what the price was, and the divergence was present, you see what I'm saying? You could have made nearly as great a return on this as you did on the put side. So, SPY, how about that?